there's still, you could tell by looking at the hour by hour action sometimes of silver or gold versus the S&P, especially silver, because some people connect it only as an industrial metal, and therefore if the stock market goes down, silver must too. Okay, they're making a mistake, okay? But you can see it in the hourly ticks where the short-term traders say, oh, S&P just dropped 5, let's sell silver off, it drops 25 cents, and the game is going on still. It's a wrong thought process, because when you stand back and look at the bigger picture, take for example, S&P made a high January, February, collapsed into April, 20% drop. What did gold do during that time? It exploded, not hour by hour, but month by month, okay? So the S&P had a sharp, cataclysmic 20% drop. It scared most people, most of that occurring in several weeks of March and April. So it was really, almost crash-like, and yet gold went up, okay? So people need to rethink that assumption, because it will trap them into missing something.
No, when we also look at Bitcoin, I know we've been seeing Bitcoin really collapsing in price recently, which is something that you've been predicting. What do you anticipate, and what is the momentum showing on the Bitcoin chart right now?
Well, we showed this over the last months, and especially back in a September report, we showed an overlay of the S&P 500 back in 1987. When it had been going up and up, and the price chart just looked lovely, Momentum had built a floor spanning a couple years where price was going up, there was rising lows, but Momentum was making the same low over and over and over again, where it was dropping down, the price was dropping down to its rising 3/4 moving average. And therefore the oscillator showed a repeated drop to the zero line, okay, a flat floor, a structure. When it broke it, it crashed. Didn't even wait around for the end of the month close to break it. It broke it intra-month, gone. Okay, this is the 4th time that Bitcoin since 2023 has dropped down to its 3/4 average. That number this quarter is 101,390. Okay, we've been trading below and above that for the last few days, so we've come down to that structure again for the 4th time. We don't think it'll hold this time. The question is, do you wait for a close, monthly close below that number? We got a long way to go to the end of November. Or do you maybe assume this time, don't wait, it's not going to hold, just like in 87 for the S&P. That's our assumption. Now, does it have to crash? No, I'm not going to argue that. Crash meaning like 30%, a matter of a week or so. But it's a disastrous number regardless. And, it wouldn't shock me that when you break this, that 3 months later, or maybe 3 weeks later, you see that the Bitcoin, which by the way is highly correlated to the month by month price action of NASDAQ 100, is 30% or lower below where we are now, meaning you could be 70,000, 60,000 or something on Bitcoin. Remember, its recent high was 127. It could cut you in half, much of it occurring rapidly. Now, the problem with Bitcoin doing that, aside from proving to the gold doubters that Bitcoin is an alternative to gold, which it is not, but it's linked to the stock market. Its inhale-exhale behavior since 2021 on Bitcoin monthly bar charts versus NASDAQ 100, it's practically an overlay. They look like brother and sister. In fact, we ran those charts and removed the name on the chart and the price scale, and you can't tell the difference hardly. So if that Bitcoin breaks our structure, and it's down to it now, if you break it credibly, like a monthly close, or don't even go lower than what you've already done the other day, like 99,000. It's likely to have a wave impact on NASDAQ 100 because the same speculative inhale-exhale fever is going on there. And sure enough, when we got Bitcoin getting bashed the last week or so, what's happening to NVIDIA and Palantir? Suddenly they become weak components of the S&P and the NASDAQ. Watch it. Watch Bitcoin. It's very important. All norms of technical analysis like RSI and so forth will be a total falsehood if you follow them. In other words, once you get silver up to a monthly RSI that's overbought, if you get out there, you're going to miss the move. Even back in, I think it was 79, you got monthly RSI above the what is the overbought level, stayed there for like 5 months. In other words, you should have bought the overbought level because it stayed there for 5 minutes, it exploded. In other words, all the norms get smashed. We have a situation in silver where, for some reason, and one reason may be artificial suppression of the market by certain banks, maybe inclusion with central bank, I don't know, where it stayed in a 50-year range. You go back and look at copper or lead. We ran those charts a few weeks ago, go back to the 1970s, and you'll see that they were in a range, 1970s, 80s, 90s, into mid-2000, like 2005 or 6, where they were stuck in this orderly reality. Up, down, up, down, up, down. And when they came out of it, literally in a few quarters, they quadrupled in price. These were different times. They weren't doing it together. Copper went up in like 2005, 6. Lead went up in 2007, so it wasn't the same driving force. But they quadrupled in price. And then since then, they've lived in a new zone of reality that's like 4 times the average price of that prior zone of reality. How come silver's still in the prior zone of reality? Look at gold. I mean, where was it in 1980? $850. Silver was 50. Okay, where was it in 2011? 1920. Where was silver? 50. Gold's 4,000. Where's silver now? 48? Okay. What's going on here? We know silver's in great demand by high technology. Solar panel production. Chinese are about 80% of that market. They need silver in the cells. And there's also AI demand for sulfur, microscopic but pervasive, okay? It's a great conductor. And we know for 5 years now, the new supply has not met demand. There's been a deficit 5 years in a row, supply-demand deficit. And we know that when silver price goes up, it doesn't induce necessarily more silver production. Why? Because most of silver production doesn't come from silver mines. It comes from base metal miners who are primarily motivated and focused on getting copper out of the ground or magnesium or whatever. And silver is just marginal to them. Therefore, if silver price doubles, it's not really that much of an incentive for them to produce more. If silver matched lead and copper, it could go to $200. Okay. Now, and also if you go back and look at 1980 high at 50 or 2011 at 50 and factor in the decay in the money unit, the buying power, the real buying power, the dollar, not the dollar index that's measuring paper versus paper, but the dollar quantity almost doubles every decade. 90% increase in the quantity of M2, Well, if you factored that in, silver probably be $200 now just to match those highs in real dollar terms. Wouldn't be exceeding them, it'd only be matching them in real dollar terms. So all kinds of things point to the acceleration phase going dynamic into a new reality.
You can tell a lot about the psychology of a market just by watching the hourly price ticks. Sometimes you'll see silver or gold moving almost tick for tick, with the S&P 500 silver especially still suffers from this lazy assumption among traders that it's purely an industrial metal. That when stocks fall, silver must fall too. You can see it happen. The S&P drops 5 points, and within seconds, silver sheds 25 cents as the algorithms kick in. It's mechanical, not rational, but that assumption that silver is merely a cyclical industrial asset is completely wrong. And when you zoom out and look at the bigger picture, the data proves it. Let's go back to early last year. The S&P 500 peaked in January and February, then collapsed into April, down about 20%. It was a panic-level drop, fast and ugly, with March and April feeling almost crash-like. And what did gold do during that same period? It rose, not minute by minute, but month by month. Gold exploded higher as equities tanked. The correlation wasn't just weak, it was inverse. That's what happens in periods of monetary stress. The speculative risk assets fall while real money rises. So when people tell me, "Oh, silver will fall if the S&P falls," I say, you're trapped in a short-term illusion. You're missing the structural shift that's happening beneath the surface. The next big move in precious metals won't be about industrial demand or stock market correlations. It'll be about the revaluation of money itself. Now, there's another chart I've been watching closely: Bitcoin. I know that gets people emotional, but hear me out. For months, we've been warning that Bitcoin was forming a dangerous structure, the same type of setup we saw in the S&P 500 before the 1987 crash. The charts are nearly identical. Back in 1987, the S&P looked beautiful on the surface. Higher highs, rising lows, strong momentum. But under the surface, the oscillator, the momentum indicator, kept hitting the same floor over and over again. The index price would drop down to its rising 3/4 moving average, touch it and bounce. But each bounce came with less internal strength. Eventually, the market broke that floor and collapsed. Not gradually, but instantly. Bitcoin's in that exact same setup. Since 2023, it's tested its three-quarter moving average 4 times. Each time, it's bounced, but with weaker follow-through. That level now sits around $101,390. And as we speak, Bitcoin has been flirting with it, dipping below and back above. It's hanging by a thread. Our view is that it won't hold this time. Do you wait for a monthly close below that level? Maybe not. In '87, the market didn't wait for confirmation. It broke intra-month and vanished like a trapdoor opening beneath traders' feet. If the same thing happens here, Bitcoin could drop 30% or more in a matter of weeks. That means we could be looking at $70,000 or even $60,000 Bitcoin before the dust settles. Remember, the recent high was around $127,000. A halving in price would not be extraordinary by Bitcoin's own standards. Now here's the thing, and I've said this for years, Bitcoin is not an alternative to gold. I don't care what the promoters say. It's not digital gold, it's digital NASDAQ. If you overlay Bitcoin's monthly chart with the NASDAQ 100 since 2021, they're almost identical. Take the price scales off and you can barely tell them apart. They inhale and exhale together, driven by the same speculative fever, the same liquidity cycle. So when Bitcoin breaks that key level, it won't just hit crypto traders, it'll send a shockwave through the entire speculative complex, from the NASDAQ to the AI stocks to the high beta sectors that have driven this bubble. Just look at the last few weeks. Bitcoin started to stumble, and suddenly Nvidia and Palantir, the darlings of the tech trade, turned weak. That's no coincidence. If Bitcoin collapses, it will drag sentiment across the speculative tech sector down with it. And when that happens, money will start rotating into tangible assets. Real stores of value, not pixels on a blockchain. That's when silver and gold will decouple entirely from their supposed risk-asset correlation and surge higher, just like gold did in early 2020 when equities melted.
The pullback, I think, is probably largely spent, if not totally spent. In fact, that was like a week or so ago. If you'll just notice what's going on, like weekly close to weekly close, we're wheel spinning. It's not really going down, down, down. It went down and then it's wheel spinning. When we examine the short-term technicals of silver, like the day-to-day, week-to-week type stuff, it's building a base, which you can't quite see it on the price chart, but on weekly momentum, I could see a clear ceiling that's been built, such that, I'll give you a number, it's tentative right now. You get these silver back above about 48.09 next week. Okay, we'll get one more day this week, okay? And I'm gonna break out of that base. So all you gotta do is spin your wheels here. And I think that's what it's doing. I think it's next to meaningless. I know every time we get one of these, there's a whole crowd of internet analysts that say, oh, I gotta go to $40 or 41 or whatever, and this is this or that and so forth. And I don't see it. I see it as a pullback buying opportunity. In fact, I'm making a list right now of miners to add to, because I'm shifting not just into silver related, but also the silver miners. As far as upside, the key trigger for us, and we've stated it over and over for the last month or so, has been the spread relationship between silver and gold. Not the net trend or the momentum of silver or gold, but the relationship between the two. Because we've examined back in the past, and when silver goes ballistic, and again, within that 50-year range, which is ridiculous, I'll comment on that in a minute, $50, $50, $50, the surge that got you up to those levels in the final phase of the 79 to 80 bull, or 2010 to 11, where silver went up fourfold in 5 months, or went up 2.5-fold in 6 months, 2010 to 11. The signal that generated that change in silver's verticality was when it broke out versus gold, the spread relationship, not evident on the silver charts themselves. Right now, the spread between silver and gold is at 1.2%. Divide D silver to D gold, express it as a percent. The major breakout level is not far above 1.3%. So it doesn't take too much to blow that spread through a multi-year high that Anybody, even an amateur technician, if you only looked at the spread chart, you could see the ceiling. You clear that and we're gone. The ballistic tone will change from accelerated price tone that we've had for the last, 5-6 months, where silver went from the 30s up to the 50s, boom, boom, boom. Then it will go into that next phase. And we're arguing that silver is about to do, again, waiting on that trigger level, spread, silver, gold, to go into a new reality. And it's not going to do it incrementally. It's not going to go from here to $150, $200 or something like that in a matter of, a year or so. It's going to do it rapidly. When mistakes are made by a market, the overpricing mistakes or underpricing mistakes, sometimes they're protracted. We see bubble tops sit up there and froth around for a long time, and then finally they fall apart. And you look back and say, I should have known that. Okay. Similar at bottom. Sometimes markets get undervalued and investors just say, phooey with that market. It's a dog. Don't touch it. And when it wakes up so fast they miss it. That's where I think silver is right now.
Let's talk about this zone of reality concept. For half a century, silver has lived in an artificially narrow price band. Every time it pokes its head above $30 or $40, someone yanks it back down. Meanwhile, gold and other metals have moved into new realms entirely. If you chart them all side by side on a logarithmic scale, you'll see it plain as day. Copper's mid-range today is about 4 times higher than it was before 2005. Lead's is 4 times higher than before 2007. Gold's mid-range has tripled since the 1980s, but silver's still the same. The laws of economics don't allow that to continue forever. Eventually, the market corrects the distortion. When silver finally breaks out of this 50-year box, it won't just drift higher, it will jump to a new plateau, just like copper and lead did. In our models, that breakout zone points to 100 to 200 silver over the next couple of quarters once the trigger level is breached. That sounds outrageous, but remember, when copper and lead made their moves, they quadrupled within a few months. It happens faster than anyone expects. Now, some people might say, but Michael, doesn't that make silver a bubble? Not at all. Bubbles are when prices rise far beyond fundamentals. In silver's case, it's the opposite. Fundamentals have risen far beyond the price. We're not looking at a bubble. We're looking at a correction of half a century suppression, and the monetary backdrop couldn't be more favorable. The global fiat system is creaking under the weight of its own excess. M2 money supply has nearly doubled every decade for the past 40 years. The purchasing power of the dollar has eroded relentlessly, not measured against other fiat currencies, but against real goods and assets. If you adjust silver's 1980 high of $50 for true inflation, not the CPI fairy tale, but real monetary expansion, the equivalent price today would be around $200. In other words, silver wouldn't even be overvalued at $200. It would merely be parity with its previous real high. That's why I say, if silver only matches what lead and copper did, we're looking at $200 silver. And that's before you factor in 5 years of structural deficits, surging industrial demand, and the inevitable flight from paper to tangible wealth. There's another misconception I want to address. The idea that silver moves only when the stock market is calm. That's simply not true. Some of the biggest silver rallies in history happened during chaos, during inflation scares, debt crises, and currency instability. Take the 1970s. Stocks were volatile, inflation was surging, the dollar was collapsing, and silver went ballistic. Or take 2020. Global markets were melting down, and silver doubled from $12 to $30 in 5 months. The trigger wasn't optimism, it was panic. That's why I keep telling traders, stop watching the S&P tick by tick. The hourly correlations mean nothing in the context of macro revaluation. What matters is not whether silver moves with or against the S&P this week, but whether the entire financial system is entering a phase of distrust. And it is. We're seeing the same sentiment in Bitcoin right now, too. People bought into the narrative that crypto would replace gold. That's collapsing Bitcoin is revealing its true nature. A speculative tech instrument, not a store of value. It's not an alternative to gold. It's a leveraged reflection of NASDAQ sentiment. And as the speculative fever cools, that capital will seek a new home. And here's the twist. When Bitcoin crashes, it helps gold and silver because it reminds people what real money looks like, what can't be hacked, printed, or devalued overnight. When you combine that with the macro picture, deficits, inflation, deglobalization, energy transition, you get the perfect storm. The new demand sources for silver are permanent, not cyclical. Solar, for example, is eating up nearly 200 million ounces per year, about 20% of all global supply. That's not a trend, that's a transformation. AI and 5G infrastructure require ultra-efficient conductors. You can't replace silver with copper or aluminum. The physics don't allow it. Every server farm, every high-speed data center, every electric vehicle, they all consume more silver per unit of output. So while speculative traders obsess over RSI levels and hourly moves, the structural foundations are shifting beneath their feet. Supply can't rise fast enough, demand keeps growing, and the financial system is losing credibility. We're entering what I call the monetary metals renaissance. Gold will lead, as always, but silver will be the leverage on that move, the turbocharger. Historically, when gold doubles, silver tends to quadruple, but this time, the ratio could compress even further. We could see the gold to silver ratio fall from 80-1 down to 40-1, or even 30-1. That's what happens when silver reclaims its dual identity as both money and critical industry input. And when that revaluation happens, the silver miners will explode. Many are trading as if silver will never rise again. They're priced for $20 silver, not $100 silver. If you run the math, some of these miners could see their earnings multiply tenfold. They're essentially leverage plays on silver bullion, trading at 10 cents on the dollar. That's why I'm heavily weighted towards silver and silver equities in my own investments. I'm walking the talk. And every indicator, momentum, structure, ratio analysis, points to one conclusion: the 50-year compression is ending. So when you see traders dumping silver because the S&P is down, remember this: they're playing checkers on a chessboard. They're watching the wrong game. The real game is the end of 50 years of paper control over a real asset. The transition won't be smooth. There will be violent volatility, but by the time the dust settles, silver will have established a new normal. Not $25, not $50, but a new zone of reality measured in 3 digits. When that happens, people will look back and say, of course it was obvious. Just like they did with copper in 2006, or gold in 2011, or Bitcoin in 2017. The signs are all there: the deficits, the compression, the manipulation, the global distrust of fiat. It's a perfect setup, and when it breaks, it won't rise slowly, it'll jump. That's how long-term ranges end, not with a whimper, but with an explosion. Silver's time has come, and for those watching the hourly ticks instead of the long-term charts, well, they'll miss it again.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.